our lecture 9, we will talk about global financial crisis. Okay? Global financial crisis. So, economics, and one sub-study of economics is finance. Okay? Which one is very important part of economics? If financial system is not properly established in the country, the country's economy will not properly work. Okay? So therefore, it is very important to study finance and at the same time economics. Okay? Good. So now, let's start our lecture with a statement of John Kennedy. Okay? He writes, if we use those Chinese characters, okay, that crisis in Chinese consists of two characters. We know Chinese is all about characters, right? And one means danger, the another means opportunity. So when you think about crisis, definitely you think about something negative, which is danger. And it is true, okay? When financial crisis happen, so people's well-being dramatically go down, okay? Consumption will go down, unemployment will increase, there will be fluctuation in exchange rate, okay, and inflation rate, which is all very, negative to the economy, okay? To the economy. But how about opportunity? Does it have any meaning? It does, okay? It does. Because when financial crisis happens, it means that there is something wrong with the economy. So that problem showed up, okay? Which means that once we know that problem in the economy, then it is our opportunity to correct ourselves and not to repeat the same mistake in the future. Okay? So therefore, it is opportunity to become even stronger by avoiding future problems. Okay? You know, the biggest crisis in the history happened in 1930s in the United States, which we call Great Depression. So in the seminars, we will talk about the details of that Great Depression. Okay? After that Great Depression, the entire world was affected. Because the United States is the biggest economy, okay, with all of those networks with all countries. So therefore, all countries had problems in their economies, okay? But after that crisis, including American economy and all other countries learned a lot of lessons. What should we do in certain cases? What kind of policies should government implement, okay? It was a lesson for everyone. But still, even though we had those kind of good lessons, many countries experienced many type of crises since that 1930s. Still, including in the United States in 2008 and 2009, which we call Great Recession. Right? Okay, good. So now, before we discuss those crises, let's talk about financial system itself. Because crises arise from problems in the financial system. Good. So we know that the nation consists of only one person? No, right? So number of people, they make one nation. So which means that all people to live in the country, to survive, they have to work and make earnings, right? Or there are exceptions too. Maybe you know about Robinson Crusoe's economy, yeah? Which means that only one person makes the entire economy. Alright? In the future classes you will learn about that one too. And that one is exception, okay? Because it's Robinson Crusoe. So we know that everyone has his or her income, right? Let's suppose this gentleman, he earns $200,000 a year, annual salary. Is he going to consume all of it? No, right? Usually he consumes and the rest he's trying to save. Okay, save. So which means that his saving is $100,000, right? Okay. So what? If we know that the economy consists of many individuals who have incomes and savings, what do we call the combination of all people's income savings? Nation's savings, okay? nation's saving, which is very important indicator of prosperity. Okay? If you find countries with lots of savings, it means that that nation's people are able to save. Able to save, it means that out of their consumption. It means they are rich enough to have opportunity to save. And this is saving very important to the economic growth because saving is equal to investment. Investment, it means running businesses. Okay? Let's consider this lady. And another thing, we know that the economy is not all consists of only one business person, right? She is an entrepreneur. And let's suppose she has $1 million. Okay? And she wants to start a business, jeans manufacturing factory. So if we get the combination of all entrepreneurs, okay, those capital investment, we call all of that combination as nation's investment. Okay? Which consists of those business persons' own capital and including their savings. Okay? So when we say what financial system is, it's very simple. While this person has saving, which is over time growth, we know that keeping your money under your pillow is never a good idea. Why? Because if it's under the pillow, it's considered as idle money, okay? Which has now no positive effect on the economy and for an individual too. All right. The only thing is it's under my pillow. I'm happy. So, and on the other hand, we have entrepreneurs like she is, with $1 million of capital, okay? And now she spends her capital to run the business, but indeed, you can find that that one is not sufficient, okay? If you consider all the businesses which were running in Uzbekistan, more than 98% of those businesses, okay, all of them, they were not established using their own capital. Alright? Which means that they had the share of those capitals invested, most of them they also come from savers. Okay? Which we get loans from the bank and invest to run our business. So the role of financial system is to be, in between these, savers and investors. What do? They try to encourage savers to invest into businesses. Okay? Into businesses. This is the role of financial system. So which means that they intermediate between savers and investors. Okay? Good. But that function of financial system between these savers and investors is too important. If proper, system not developed in our financial system through financial institutions, okay, the flow of financial resources to investors will not be properly established, which means businesses will not grow. Okay, good. And as individuals or households, we have two types of investment, right? One, we can directly invest. Another one is indirectly invest. If we want directly invest, we have already learned in our previous lecture, foreign direct investment, right? Where households can invest through financial markets. Through markets of bonds, okay? Or through markets of stocks. When businesses, okay, they try to raise financial capital through printing bonds, publishing bonds. What do we call it? What kind of financing? It is debt finance. Okay, it's debt financing. Or if businesses they start to run their businesses through offering stocks to have shareholders, it is equity financing. Okay, this is direct financing. Direct financing. Okay, good. Here's the question. Does the purchase of a stock on a stock exchange market provide new funds for investment projects? If you buy stock from the stock exchange market, does it provide any new investment to the businesses?
Yes,
It doesn't. Okay, why? Because let's say I'm the investor, okay, and I invested, I have stocks in my hands, which means that 40% of the company belongs to me, right? But in that foreign exchange, the exchange market, I want to sell it. My money is still there, but the owner of my stock is now changed. Nothing. There isn't any investment further down, okay? That's ownership change. This is it, okay, which you should know. Good. What about indirect financing? In order to indirectly finance, we have financial intermediaries, right? Like banks, mutual funds, pension funds, insurance companies. All of these financial institutions, okay, try to get deposits or investments from savers and invest it into businesses, okay? It's their way. So this is why, how is it important? Why the indirect financing is important? Because of certain risks that may arise, okay? So, if you consider the entire nation, okay? If you ask them a question whether they are willing to invest their savers, okay? Most probably you will get an answer 50-50, or they are not going to invest because of the risk that may arise, okay? So indirect financing tries to reduce risk. Let's suppose I have $1 million, okay? And I want to establish a business. So, which is, this $1 million is very sufficient to establish my business. But certain business, elites, okay, they try to minimize even though they have capital. Because we don't know for 100% that this business is going to be successful. If you are not 100% sure that it's going to be successful, I personally try to minimize the risk through offering stocks. So now I will spend half, okay, 50% of my capital to this business, and the remaining, the investment I will generate through stocks. Okay? Why? Because, of course, if it's going to be successful, I will get revenue, which is good for me, right? But if it's going to be unsuccessful, if I invest everything, I will lose everything. So therefore, if I try to, increase the number of, stakeholders from my business, if it's unsuccessful, they will be also sharing those losses together. Okay? So that way, it's a very smart way to minimize risks, okay? Of course, if I know that it's going to be 100% successful, I will spend everything. If it's needed, I will sell everything that I have to finance it. My house, my car, my brother's car, I will ask him to sell because it's very promising, okay, business. Good. Who do you consider as a risk-averse person? Risk-averse. A person who is afraid of taking risks, yes? If you consider the entire economy, you will find more than 90% of people are risk-averse, okay? So therefore, to minimize the risk and encourage people to invest, deposit their savings into banks, okay? Banks play a very important role. Why? Those financial intermediaries, they try to reduce the risks. We talked about mutual funds, yes? How do they minimize the risk? So they invest into multiple businesses, right? Which are not perfectly correlated, right? Banks do the same. And other financial institutions, they also do the same. So which means that people are more confident not to lose their capital. Okay? So therefore, the role of financial intermediaries, okay, institutions, is very important because they give to diversify their risks. Okay? The risks. Good? So there is such a thing like asymmetric information, which means that once business is, established, one party knows more information about savings, and they have an investor, a person who is going to start a business. Who has more information about the business? Investor. The investor has more knowledge about the business. Okay? So this asymmetric information has two types. Okay? First one is hidden knowledge about attributes of business, which means, for example, if that entrepreneur, that lady, wants to establish jeans manufacturing industry, okay? For example, a saver who's going to invest doesn't know perfectly whether the design of jeans she's going to produce is going to have wide appeal in the economy. For example, this type of jeans. Let's suppose if one person among you wants to start a business and I have savings, for example, and you're asking me to finance, you are economists, you understand me the best, please finance my jeans manufacturing business, and I want to produce this type of jeans. My answer is going to be 100% sure. Why? Because our market is not ready for this type of jeans yet. Okay? There are, of course, people who are wearing it, but they're very, very minority. To spend millions of dollars to establish that business is not right way. Okay? Right way. So another thing is, regarding that hidden attribute, is the entrepreneur a talented businessman? I don't know. Okay? If I perfectly know, then it's okay. So therefore, this kind of hidden knowledge about attributes raises adverse selection. What does adverse selection mean? For example, I have this $1 million, let's suppose saving, and there are thousands of businesses who want to start their business, and they need money. So which means that I have a choice to choose. Adverse selection means choosing wrong one. Okay? Wrong one. So because of this kind of hidden attributes. Another one is hidden knowledge about the actions. Let's suppose that business lady, she got that that $1 million, which is sufficient to finance her business. Okay. The day she got the money, maybe she will invite all of her family members and friends to a luxurious restaurant to give a party, which has nothing to do with business. The next day she will order super expensive furniture from friends in order to have luxurious looking office. The following day she will buy a very brandy nice car, which is going to take her from her home to the office, which has nothing to do with business. Of course it has very little. Okay? So which means that it's another thing whether that financial project that we are going to finance, that person who is getting that money is not going to act in a wrong way. In other words, we call it moral hazard practiced by business elite, okay? Or businessmen. Good? Alright. And how can those individuals or households, okay, can minimize or avoid this kind of adverse selection and moral hazard problems? Who can help? Banks, financial institutions. Why? For example, if you want to start a business, okay, whatever your intention is, whether it's good intention or bad intention, you have to apply for credit, yes? Can you go to the bank and directly get credits? No. Yes? No. Why? Because they will check everything regarding you. Your credit history. If your credit history is very bad, they will not say, yeah, sorry, we are not going to offer you any credit. If they agree to offer you that credit loan, they will ask collateral, which means in case your business is not successful, they have something else to recover those capitals that they offer. Okay? So this is one way households can approach. Okay? Good. And what's the role of government? So if you consider all financial institutions like banks, are they able, to control all the moral hazard and adverse selection problems perfectly?
Government says.
Still, they are not able to do it, right? So those are, wrongdoers. They always try to find some other ways, right? So here, government. So the role of government is crucially important. If banks are facing certain problems from their credit, yeah, it means that they can ask government to help, which means that they will persecute those who are causing trouble in paying back that money. Okay? So, another way of government's importance, if let's say, if someone wants to needs financial resources, okay, for the business, government can ask them to make it publicly available about the reports. Which means that before financing we can take a look at their reports and see whether the company for the last 5 years, whether it was successful or not. If we see that the growth is like this, we will be happy to finance in advance. Okay? So they try to minimize those risks through persecution and making those information transparent. Okay? All right. We talked about financial system. Okay. What about financial crisis? If we, in short and in general, what financial crisis is, financial crisis happens when financial inflow of capital resources from savers to investors is disrupted. It causes financial crisis. Okay? When the economy or financial system is not able to direct savers' money to the investors, then financial crisis happens. Doesn't matter what the reason is. Financial crisis usually caused by war. Financial crisis caused by the reduction of prices of resources like oil. Or it causes through political instability. And many other factors. Okay? And if you consider all of them, it comes to this problem. Okay? And this problem between savers and investors, if it's interrupted, then it causes and makes the economy weaker and weaker because financial system is not working properly. Okay? Good. So in other words, financial system is not able to intermediate between savers and investors. Okay? Good. So there are 6 elements, main elements of financial crisis. Okay, what we call anatomy of crisis. I will explain it one by one, and we will consider the case of Great Recession in the United States. Okay? In the United States. So in 2008, right? Between 2008 and 2009, the biggest economy in the world, the United States, they experienced Great Recession, financial crisis. Okay, good. And how did it all start? For example, so years in our horizontal line and mortgage price in vertical line. What caused financial crisis in the United States? It was due to mortgage price fluctuations, right? Okay. In 2001, it's starting from early 2000, the prices of mortgages started increasing, yes? And it reached one point that after the prices started declining. And this decline caused financial crisis in the United States. First of all, why the prices of those housing went up, okay? For example, one main reason is in 2001, Federal Reserve, okay, with the encouragement of the government, they reduced the interest rate to 1%. If you get mortgage, you have to pay only 1%. For example, in Uzbekistan today, if you are very successful to get a mortgage, and even using your friends and someone who knows, okay, with connections, maybe you will be able to get those mortgage for 18% or 17% interest rate you have to pay. Otherwise, it's going to be over 20%. But in 2001, they made it 1%. Can you imagine? Can our government, request from our banks to reduce it to 1%? Why not? Government. If they ask them to do it, they will do it. But government will not do it. Okay? Because they know that it will cause big problems. If they announce that to make it 1%, I will not find any of you during my lecture seminars. Maybe you will be lined up in the banks to ask for mortgage. Okay? Because it's 1%. While average inflation rate is over 10 or 15, okay, which you can gain. All right. Anyway, so once it was very easy to buy housing using those mortgages, okay, demand for houses increased. As a result, price started going up and up and up. When prices started rising in the United States, people, they thought that the prices of houses will be rising. It will not be fall. Or in that worst case, it will reach one point. After that one, the prices of housing will not fall. Okay, it was the way they thought. But when it reached this point, okay, some people who are very optimistic about the price increase or stable price, that optimism turned into pessimism. Okay, then that bubble burst. Okay, so therefore it's called asset price boom and burst. Okay, prices are booming and it burst. Optimism turned into pessimism. Which means, why it happened? When the prices reach this point, okay, some people, minority, it started with some, they thought, now, the price reached that level. I don't think that the prices will continue rising. Now it's the best opportunity to sell it. Okay? Best opportunity. Then, a few people started selling their houses. And the others, they see that something is, goes wrong. And, then other people started following, which means housing, supply of houses to the market increased. And slowly prices started reducing, slow reduction. When slow reduction was experienced, so many people, they saw it, now prices are going down. Now it's the time for us to sell our houses, otherwise the prices will be very low. And it was like a panic time, okay? And the prices after that one, it was sharp reduction. Good, okay, it happened. And how does it cause crisis then? If, for example, in Tashkent, the prices of houses, goes down by half, I will be very happy. And at the same time, nothing. Because I'm economist. Okay? If the price is up, I have one house apartment now, because I have two sons, I will buy another one. Which is a good chance for me to buy when it's cheap, right? But as an economist, I know that if we experience the same thing, it will affect the entire economy, which means that it will make poor all people, including me. So, how does it cause damage? So, it's second one. Insolvencies at financial institutions, which means that banks become weak. Why? How do they become weak? For example, when the prices were at this point very high, okay, there were thousands of people who got mortgage at this price, okay? Let's say it's $100. They got mortgage and they bought house, okay? Just after a few months, the prices of the house went down, for example, to $70. They are owing $100 to the bank, but the actual price of the house is now $70. Okay? So now, because of that one, people start paying back those interests. Alright? So then now they think that, now the actual price is, $70, but I have to pay $30 more. Why should I do it? For example, for the one who got mortgage, it's easy, right? If they stop paying back, what will bank do? Because the collateral in terms of mortgage is house itself. The only thing they can do, they can take away the house from you. This is it. So now, at this point, those banks, okay, when those people who are defaulting, they are taking back, and the loss to the bank is $30, right? It's not for an individual, it's loss for the bank. Which means that bank offered thousands of houses for $100, but now they're returning back for $70 in a very short time. Banks lost that much. If they lose, all of the $30, banks become weak, very weak or bankrupt. Okay? Good. For example, investment banks like Bear Stearns and Lehman Brothers, okay, they faced that kind of very big problem. They were in the edge of bankruptcy. Or mortgage market like Fannie Mae, okay, Freddie Mac, they experienced the same. Or insurance companies with AIG, those giant financial institutions. They were experiencing because of this loss. Okay. When banks become weak, is it a problem? It is a very big problem. Okay? Why? Because people lose confidence in those banks. So now, American people, they saw that those big giant institutions, they are becoming very weak and they are on the edge of bankruptcy. So what did they do? They were running to the banks, especially those whose deposits were not insured, okay? Requesting their money back, okay? Requesting their money back, which means that once they request their money back, are they able to pay back everything?
No.
No. Because they are not able to pay back, they need what? Loan from some other institution, right? Is there any institution who is willing to finance those, dying bank?
No.
No. Government will, okay, we will talk. So those private ones will not give anything, right? Once they were not able to do what were they doing to return that money back, they started selling their assets. Banks. When they were offering their assets in the market, there was more supply of assets, okay? So banks' asset prices started going down. And in each bank, those accountants, because they have to at the end of the year look at the liabilities and assets, the assets price now, its market price is now much down, which means it affected all banks. Some of them, they tried even to get rid of those banks, assets, which further decreased the prices of assets, making all banks get weaker and weaker and weaker. Okay? Good? Alright. And then credit crunch follows after that. In Uzbek language we have such a saying, right? If you, for example, burn your mouth by drinking some hot soup, you drink yogurt, that cool yogurt, you blow that yogurt before you drink, yes? Which means that because those banks made big mistakes, because they were offering mortgages without thinking, and they were offering mortgages to even subprime mortgages, which means that those customers with very risky background, they have gone through. Because of that one, they are now in that situation. To make everything strict, those businesses with very good business opportunities, even they had problem to get credit from the bank. One bank, they wanted to keep that money at home in the bank. Another one, they were checking all the processes very severely, all detail. What happens if businesses are not able to find financial resources to finance their businesses? It will cause economic recession. Okay? It will cause economic recession. Once recession starts, this is it. The problem gets bigger and bigger and bigger. Why? They don't have enough money to finance their business. It means that if they want to survive, they have to make their businesses smaller. If they want to make it smaller, it means that they have to hire less people. Some of them are not able to run the business. They have to shut down their businesses. It will cause unemployment in the economy. When there are more and more unemployed people, it means that they don't have enough earning to consume. If people are not able to consume, then other businesses are not able to sell their goods and services. And those businesses start getting smaller. More unemployment, okay? And then it causes vicious cycle. What does vicious cycle mean here? For example, at this year, okay, at this moment, thousands of people, they defaulted on their mortgages, okay? And the remaining thousands of people, they were still paying those interest rate to the banks. But after recession, those people who were paying, they lost their jobs. Which means that they were not anymore pay back those interest to the banks. The only thing they could do, unwillingly, not to pay, and banks, they were taking back those houses, okay? And in the bank, situation was getting even worse, all right? So which means that this cycle started again. Or it's like this. First cycle, it will be very bad. The second one, it's going to be too bad. The follower will be even worse. So therefore, when it was somewhere here, government of the United States intervened in order to stop it. Okay? What is the medicine for financial crisis? Injection. Okay? Which injection means money. Okay? Good. So what did government do? First one is that they implemented monetary and fiscal policies. Okay? For example, when the United States experienced Great Depression, which started in 1929 and it lasted for 3 years, and actually that effect was more than 10 years, okay? It was British economist Keynes who wrote a letter to Roosevelt, okay, the President of the United States, to find some solution to the problem. So what was his advice? He advised, in order to make economy again properly operate, American government should try to increase aggregate demand. which you are going to learn in the later levels, okay, in macroeconomics. So now, central bank plays a very important role to solve the problem. Okay, how can they help? One reason why economy of the United States was going down and down, it was due to because of aggregate demand. Entire nation's demand was going down. Because less salary, less demand, it was this. So now government should try to increase aggregate demand in the country. So what can central bank do, or Federal Reserve? Okay? They should increase money supply. Why do they increase money supply? So once people have more cash in their hands, they will start spending. Once we spend, we consume. Once we consume, our business starts working again. Another one, lowering interest rates. In other words, it's easier to get credits and invest into their businesses. Because now interest rates are low, they can get investment, invest, they can hire more people, pay for them. If they are paid, they will be consuming more. Economy starts working again. On the other hand, what about the government? For example, fiscal policy. It's one, government should increase government spending or reduce taxes. For example, when economy is in a very bad situation, right, you will find those countries start building very expensive roads, which cost billions of dollars, or bridges, or airports, okay? A person with, no economics understanding would say, what is this government doing? While people are starving from hunger, they are building these roads. I think this, government is not very stupid. It is that kind of argument can be given with economics illiterate person. Why? Why does government do it? Because they want to increase money supply in the economy. Once they are spending for billion-dollar projects, they are going to hire thousands of people for whom they are giving salary. And those people who get the salary, they will be spending. Which means that spending will increase demand for goods and businesses again start working. Tax is the same thing. From income tax, if your government gets less income, it seems that now we are richer. We will spend more. For businesses, if it's less tax, their cost of their goods will be cheaper. They will be able to sell more, hire more people. Okay? Good. In the case of United States, indeed it happened. For example, Federal Reserve, they got its target for federal funds rate from 5.25% to nearly zero, or zero. Just in order to increase money supply in the economy. And they kept the same for 3 years. In 2008, for example, Bush administration, they signed into law that 160 billion stimulus package dollars for taxpayers. For example, you go to tax officer, let's assume yourself, Let's say you are running business, and now you have to go and pay tax, right? What did they do? For example, you go to the tax office, this is $1,000 for this month I have to pay. But because of our new kind of regulations, now we have some discount. This $700 we are going to get, and $300 just take it back, please. All right, take it back. Or for some it was 1,200. You are going to give all of the money, but they are returning $300 back. What will you do with that money? It's just as if it's fall from the sky. You will get that money. Whoa, let's go to the restaurant. Now that money I have. They try to increase demand through that way. Once we return that money back, those people start spending it. It's good for the economy. Or Obama, when he became the president, the economy of the United States was in the biggest point. So then he signed into law that almost $800 billion stimulus package for government spending and reduction in taxes, okay? Just to help the economy. And really it helped. Of course, it was not marvelous, okay? But it still helped. Now the economy is fine. Okay? Good. Another one. Lender of last resort. What about this one? For example, I said, when banks are running out of business, they are running out of business because they don't have money to pay to those depositors, yes? Okay, but indeed there were banks which were very weak. They were not able to do it. But at the same time, there were many other banks, okay, many other banks which were financially very strong, still sound, but once those depositors which saw that, those financial, banks, they are, falling one by one, and these people, they was on, most probably this bank is going to be the next one. So therefore, they were running to get their money back. You cannot find any bank which is able to refund everything in a very short time. Okay? So even though they were very strong, they are not able to do it in a very short time. Which means they need money. So what did Central Bank or Federal Reserve do at that time? Okay. One thought liquidity crisis. It means that even though this bank is strong, they are not able to pay it back. Why they are not able to pay it back? Because they have money, one is student loan, and it's in another business, which is not possible to get it back. And if they are not able, it is called liquidity crisis. Okay? At this moment, the role of central bank is very important to make it survive. Because they need this money, now central bank can give them that money. Now people are flooding the bank, okay, to request their money. If they're able to get that money, okay, what people, they're coming, I want my money back. Oh yeah, sure, how much we have? This money, here. The next is coming, how much? Here. Everyone is coming, there isn't any problem with the bank. They will think that, I think there isn't any problem. Why should I taking my money and keeping it in cash? Okay, here's the money, just please take it back. This is the reason why I try to help. Okay? So which means that once confidence is regained, bank will be operating properly again. Okay? Good. So that one, when bank helps in that last moment, it is called lender of the last resort. Okay? Therefore, central bank's role in the country is very important. And during those crises, even those shadow banks, mutual funds, pension funds, they got the same help from Federal Reserve in the United States. Okay? And what about the policies? Injection of government funds. Budget of the government. Whose money is this one? Nation's money. Does government have right to spend it in any way they want? In risky projects? They don't, right? But during the crisis, they do it. In order to help the economy to run properly again. For example, in the United States, before 2008, the insurance, okay, of deposits was $100,000. Which means that if it was more than $100,000, you lose it. Insurance is able to cover only $100,000, give it back. In order to regain those depositors' confidence, they increase that $100 to $250,000. Okay? Dear depositors, we know that you are in trouble, but don't worry. If you are going to have, if you think that if you are going to lose your money, government is going to pay you back up to $250,000. Okay? All right. And then another, government started making risky loans. For example, that Bear Stearns, one of the that investment banks, very giant, okay, they were on the edge of bankruptcy. The one possible way was that Federal Reserve, they had to help it, okay. Rather than directly help, they tried to encourage that J.P. Morgan to purchase it, and for that one they gave loans of $29 billion, which was very risky. Collateral was this bank itself. Or in 2008, Federal Reserve, they lended $85 billion to that falling giant insurance company AIG. If that Federal Reserve, if government did not do this kind of help, actions in order to help these financial institutions in 2008, I really believe that that financial crisis could last for at least 3-4 years more. Okay? And government itself injects public funds into financial institutions. All financial institutions were becoming weak and weak. Okay? In order to help them, Federal Reserve, they were becoming stakeholders. They were buying stocks. In the late 2009, they had so much stocks of that government, okay, having in those banks. They were owners. Okay. Focusing, policies to prevent crisis. Once those things happened, and economy started reviving, okay, then one problem, it was due to risk taking, especially from insurance, yes, which means that if people they lose their money, government will pay it back, yes, okay. Is it a good thing? It's a good thing, right? But it sometimes causes very strong side effect. For banks, they know that if something goes wrong, government will pay it back. So which means that they will start taking risks. If they take risks, it's too bad. So in 2008, government started, not allowing those to take risks, okay? Good. Restricting the size, it was another. If economy has thousands of small banks, if one small bank fails, it does not affect seriously to the economy. If one big bank like Bank of America fails, the entire economy will fail. Or if our National Bank of Uzbekistan, if it fails, entire Uzbekistan will feel the pain. Okay? So it's one, which means that getting bigger was not encouraged. Okay? Good. And reducing excessive risk taking, government tried to do it, and making regulations work better. Okay? Alright, we have 3 minutes left. So, and who blamed? Whom to blame? Look, when those financial crises happened, everyone was blaming everyone. People were blaming Federal Reserve. It is you who made those interest rates low to 1% and prices of mortgages increased, okay? Federal Reserve was blaming people. It is you were, getting, carelessly for even, that, house of gamble. Some people indeed, they were doing it. When price goes up, I will sell. Okay? So, which means that all of them, rating agencies, regulators, government, policymakers, everyone was blaming everyone. And there is no perfect answer which one to blame more. Okay? So, this is the book, Macroeconomics. Alright? Please go to chapter 20. Its 8th edition and 9th edition is also available. It's very simple to understand because it's written by many. We are done for today. Now you can go.